Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to show you the buys we did in the portfolio today. In the tax-free savings account, we're going to update the dividend tracker on trackyourdividends.com. We're going to update share site to show you the performance of the portfolio. Then we're going to talk about a few things, just some tiny things. So I'm going to do this as quickly as I can, if I can fit this all in this video. So if you're new to the channel, welcome. This is where you put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. Whew. If you're not new to the channel, welcome back. Almost broke my neck there doing this all the time. So for the day here, portfolio end of the week closing out at $13,616.77, up $48.10 on the day, up 0.35%. Not bad for the day. Going with everything that's going on, and that's probably what we'll talk about today. Down $296.40 for the past week, down 2.13%. For the 1 month, we're down $889.74, down 6.12%. For the 3 months, up $362.69, up 2.73%. For the 1 year, down $11.16, down 0.08%. And for the all, up $1,011.82, up 8.01% since starting this portfolio. As we do every single week, we do make a purchase of one full share, and the share we bought today was Bank of Nova Scotia, closing out today at $71.25, down 10 cents on the day, down 0.14%. Holds about 9.44% of the portfolio. Our average price of getting in is $71.77, so our price is slightly higher than what it closed out at today. We have 18 shares, and we purchased one share today at $70.79. And as we do every single week, we do purchase a fractional buy into VFV, which is the Vanguard S&P 500 Index ETF in Canada, non-hedged. Hedged is the VSP version. That's the ticker symbol. Ticker symbol for this one is VFV, closing out at $91.52, down 39 cents on the day, down 0.42%. We now have 9.7199 shares. Average price of getting in is $95.15, quite a bit higher than what it closed out at today. It was about 6.54% of the portfolio. And I'll show you the buy here right now, which we purchased 0.2733 of a share at $91.46, given some of those fractional cents of 0.17. So that is the buys we did this week. Now we'll head over to trackyourdividends.com to update things quickly here. So yeah, portfolio today closing out at 13,420 on here. Portfolio yield, if you're to build this portfolio today without the updated positions, you would have a yield of 4.04%. For us, we got a yield on cost of 4.37%. Annual income coming in at $542. Of course, divided quarterly because dividends typically get paid out quarterly. So go ahead and add a holding. VFV comes up .to, purchase 0.2733 shares at a cost basis of $91.46, 0.17. And we'll go ahead and add that holding. There it is. And we'll go ahead and add another holding, which was Bank of Nova Scotia .to, purchased one share today at a cost basis of $79 $70.79. I'm just going to double check that because I don't want to make a mistake. Yep, $70.79. We'll go ahead and add that holding, and boom. So with the updated positions, nothing really changed on portfolio yield. We're still getting 4.04%. Our yield on cost is 4.37%, and annual income is now $546. If we look at Bank of Nova Scotia, we're getting about $74.16 per year, divided quarterly, of course. And VFV, we are getting about $10.93 for the year, of course, divided quarterly. That is the trackerdividends.com. As you can see here, we're expecting to get $27 for the month of September and $82 for the month of October. I don't know what's going on there, but it should be equaling out, but whatever it is, those are the expected dividends for the next months here. So we'll head over to ShareSite, and this one has been updated already. The great thing about this site here, and of course I pay for this one, is it tracks your dividends, tracks your currency gain, and your capital gains, so your capital appreciation in the stocks, and it gives you a total return. So yes, we are here, and capital gains, we are down $1,468.32, down 9.88%. Dividends, we received $316.32. According to this site, up 2.13%, and currency gain $132.82, up 0.89%, which brings us to a return of down $1,019.18, down 6.86%. And so that is ShareSite, of course. And yeah, that is the portfolio for the week, guys. Lots to talk about this week, but one of the biggest things, well, some of the things I kind of want to touch on is there's some ideas that a depression could be on the brink, specifically in the US, because technically Canada is not in a recession yet. The last 2 quarters that we've had have had a GDP growth of 0.8%. And now that doesn't seem like a lot, but it is still a positive direction. Where the US has had 2 quarters of negative growth, which technically means they're in a recession, because a recession is 2 consecutive quarters of negative GDP, which is gross domestic product. So let's talk about Canada a little bit, because for us Canadians, I know typically we get a lot of news from the US, and we kind of just follow suit. A lot of Canadians do not actually follow what's going on in Canada. They typically follow what's going on in the US. And although they are typically, anything that happens in the US typically will happen to us, there is a bit more regulation in Canada when it comes to the way banks operate, the way we kind of do things. And I say we as in Canadians, and typically we'll follow suit, of course. So now that the US is in technically a recession, there are a few places and countries that will typically follow that trend in, let's call it, the next 6-12 months, probably the next 12 months here. You have us, Canada, that are like just touching, that center line where we could end up being in a negative GDP era. I think Australia would follow in that category. The EU zone, so all the European countries there. Japan would definitely be in that category, and South Korea would be in that category, where recession is literally possibly just around the corner. And of course, because our last quarter was positive, it would take 2 quarters. So we wouldn't see something until maybe 2023, well into 2023, to see those recession numbers, to know that we were in a recession. Now, this whole depression thing that is happening, the last depression was the Great Depression. And I don't know if that's possible. I think we're knowledgeable enough not to get to that point. Now, we may not realize this, but we were in a recession just recently. And that was during the period of March 2020 to August of 2021, where we officially got out of a recession. Now, a lot of people don't mention that, because during that period of March and into August, things started, like, the market was doing great. We were still technically in this bull run of a market, and everyone was a genius because, of course, everyone is a genius in a bull market, and as the saying goes, so on and so forth. But now we're kind of in this place where it might even be a bit more prolonged, in the sense where a recession could happen, but this could last longer than what 2020 to 2021 gave us. And what does that mean? If we look at like indicators of how we should probably operate in our own finances, I typically will look at what the banks are doing, specifically the Canadian banks, because I don't really have interest in the US banks, even though they're quite large. They do things that are kind of interesting. And the only reason they are able to do that is because they are not as heavily regulated as Canadian banks are. Canadian banks just don't have that freedom. And so with Canadian banks, we know that in the last quarter, in a lot of their statements regarding their earnings, there has been quite a bit of funds being put into loss provision. And loss provision is the expectation of bad loans that they can pay that back with these reserves. And they did the same thing in 2020 during that time, as we all know, and they did it quite aggressively. And now they're doing it aggressively again, expecting things to not go as smoothly as we would all hope for. And so I always use the banks as a good indicator on how to operate my own finances and continue to consistently invest, because banks are doing the same thing. They are consistently investing, they're consistently taking on risk, giving out loans, but also at the same time, also mitigating the risk for any future unexpected events. Now, if they're doing that now, remember, these are billion-dollar companies. Why aren't we, as Canadians, doing typically the same thing or following suit? Now, I'm not saying I'm a genius or anything, or I'm smarter than the banks. I think the banks are pretty dang smart, where they have a team that typically analyzes all this stuff and projects things. And I think it wouldn't be a bad idea. We should operate ourselves like we are a business and not continually letting the burn rate burn so fast that we will run out of funds. And so now's the time, in my opinion, is to start putting some funds away into your reserves, your cash reserves, to expect the worst. Because if Canada truly follows suit in what the US is doing and what they have going on, we will probably be seeing the same thing just later down the road. So it kind of gives us this time to prepare for what could happen. And I could be totally wrong. We could end up being just fine. But just to have that safety net. I mean, if you think about it, 70%, well, Canadians on average owe about $70,000 to the banks. That includes everybody that is Canadian. And that's a big number. That's a down payment, pretty close to a down payment on a home. And with my horrible segues, we'll just talk about the home section there, specifically my generation. My generation and maybe a few other generations have been complaining. I shouldn't say complaining, but feel like housing is unaffordable. And I think in 2020, a lot of people it was like a trend where they were hoping for a housing market crash, and didn't happen. Sorry to burst your bubble. Okay. But with all that complaining, I'm not one that is complaining about housing or the affordability of housing. But if that were to happen, and I might get a lot of flack for this, is the generation that is complaining, which is my generation, the quote unquote millennials, are you prepared? Are you prepared for that? Are you ready to jump in when that happens? Because based off statistics, Every Canadian owes about $70,000, and that includes, you know, the student debt, the affordability, the jobs, and so on and so forth. If we go into a recession, jobs typically will disappear, unemployment will go up, and you will have no money coming in. And what gives that generation the ability to purchase a home? Interest rates are going up. You have to qualify at the rate that the bank will give you plus 2% for the stress test, and you have to have money down, and you have to have income, and you have to have somewhat of a money down. Are you in a position to do that? Because if you were in a position to do that, wouldn't you have bought a house back in 2020 when interest rates were on housing, below 2-3%? Who knows? Or would you be buying a house now? Because even now, interest rates are much lower than what they were in the 80s. Remember, in the 80s, mortgage rates were double digits. Imagine paying credit card interest on a home, and fondly enough, that generation that did pay that interest rate back in the 80s are still seeing the interest rates now. I'm talking prime rate and lending rates, still pretty low compared to what they went through. And so just take that into consideration. I just wanted to mention that because I remember that being a thing. And to be honest with you, there are quite a bit, and they don't get the news that they deserve. There are quite a bit of people in that millennial generation that have bought homes, that have worked very, very, very hard to, scrounge a down payment together to get their finances in order and purchase a home and still invest and so on and so forth. I want to, if that's the case, I hope you do find that opportunity for yourself to buy a home as a millennial. But I think it just comes down to, understanding your finances. It's not other people's problems, or another generation's issue that our generation kind of missed the boat. It just takes a little bit of hard work, a little bit of elbow grease, I guess they would say, those old timers. So other than that, guys, just wanted to say that out. But thanks for watching. Don't forget to leave a like and subscribe. As you can see, my screen went black. So that is a sign for me to go. Have a great week end. Don't forget to leave a like and subscribe, and we'll see you in the next one. Bye.